Good day, fellow investors. ULTA Beauty is now a positive risk and reward stock to buy, and in this video we'll discuss the risk and reward, how I came to that conclusion and how it might fit your portfolio. For those who don't know me, my name is Sven Karlin. I have been investing for more than 20 years now, and the focus on this channel is value investing, and I think we might be among the largest value investing channels on YouTube. So let's immediately dig into the core with ULTA, and they have just had their investor day, and this is the key: their long-term financial targets. Revenue 4 to 6% growth target. This is 2026 to 2030 what they are talking, but this will drive the investment thesis, the stock and everything. Operating profit in line with their historical operating profit for their stores, and then alongside buybacks, where we have a 3 billion buyback new program already there, which is significant on the 17 billion market cap, should lead to 10 and higher % earnings growth going forward. If they hit that, the stock will double in the future, because when you look at the numbers here, the market cap now is 17 billion, P ratio is 15, but if they manage to grow 10 to 12% earnings over 4 years, then the earnings will double to 40 to even 50, and if that happens, EPS, let's say 40 in 2030, the P ratio for such growth stocks might remain at 15, but it should usually go to 20 when the growth is there a few years in a row, perhaps even 25, because the market gets excited. 40 times 20 is 800. Put it more conservatively, you have a 2x here from ULTA. And you can see that it has been a compounding story for the last 15 years. Now there is this slowdown, but if they keep on compounding, the story might continue. They have had a really long presentation on their investor day on how they plan to remain with that competitive advantage. The business is surely very sticky because 95% of sales come from members, and the members there is growing aggressively, increasing that membership, because then it is not just about buying and comparing prices that we'll discuss later, but it is also about that service and going somewhere where you feel a member. And Warren Buffett also knows that because he bought the company, and we will discuss that. Pandemic, of course, many businesses have seen the boom after, and now we will return to that normality, likely growth for the beauty sector. But if they can grow faster than the market, especially the earnings, maybe not even that much faster, 5% revenue growth, keep their profitability stable, not as high as it was during these exuberant times, if they can keep on doing the cash flows, 1 billion, no matter what we discuss now, you see the downturn, they are still doing the 1 billion cash flows, 6 billion return to shareholders, and that is 30% of the current market cap. New stores are still profitable, still delivering 20% returns on capital, and you can see here how the payback period is just 3 to 4 years on the investment. 2 million it costs to set up a new store, and they have planned to increase the number by additional 200. That should also drive growth. So revenue growth, operating profit growth, share repurchases, and the EPS should grow at 10%. If they deliver this, things will look good going forward, but now they are in a transitional period, and the situation is a little bit tricky with increased competitiveness, but they have been in such situations also earlier. If they do it, I'm telling you, a 2x is a minimal over the next few years. Always conservatively, no near-term change to current policy of no permanent balance sheet debt. This is conservative, so very interesting from that perspective. New 3 billion buyback authorization on a 17 billion market cap. 3 billion is a lot. But as a value investing channel, there is always the risk side that we have to discuss, and it is a possibility, but given the strength, given the members, given that stickiness, and that's also something we'll discuss, it might be a low risk for the potential reward for the cash flows that are already there, even despite the slowdown. But we have to discuss the competition that is there. And I just went to ULTA, and I don't know, the oil-free makeup remover costs 11 for the 5, 14 for the 8. And if I compare that to Amazon, it is way cheaper. But you are also then giving a service, the stickiness, so those that don't care about the cheapness, you can find it cheaper elsewhere, and that is something that is slowing them down, but at some point it should stabilize. Buy the same for 14, 8 ounces, I think, and this is also 8 ounces pack of 1 for much cheaper. They have to see how they can keep their competitive differentiating position compared to cheaper things as Amazon. But there is another confirmation there. Berkshire invests in ULTA Beauty. The stock jumped when they announced that, but Buffett bought in this quarter, so now you can buy at a lower price than Warren Buffett does. However, again, a risk, and this is a video that we discussed how Buffett usually sells 9 of the 10 stocks that he buys. So he buys, he tests. If things are really good, keep in mind cash flows 1 billion on 17 billion plus growth. Maybe Warren is just testing. If he likes, he will take it out as a nice retail membership business, which is something that he likes. The next stage in investing is how is the enthusiasm there compared to Sephora? Are people going more to others or not? And if I put this on our value investing quadrant, 12% growth of earnings on a P ratio of 15, the return is pretty high for ULTA, 12%, and I think the risk is average there. So ULTA looks much better than this bunch of companies, much better than this from a risk and reward perspective, but there is some risk. I hope you enjoyed the video. Thanks for watching. Smash that like button. I'll see you in the next one.